Hey all, in this video we're going to be doing the FIN117 main exam. So let's go ahead and go to question 1. Now as usual I'm going to skip ahead and go straight to the question and see what's actually required. So in this question 1 we are required to calculate the current tax liability. So straight away my mind is going, okay, this is a tax question. What we need to do is pull up our exam Bible, which is the journal templates for FIN. Pull up tax, which is unit 4, and there we go. Straight away we've got a template that we need to follow to actually answer this question. So what we're going to need is we're going to need a few different fields, accounting profit, and then put in our adjustments, calculate our tax, and then we'll then have our current tax liability. Okay, so what we're going to do in our exam paper, we're going to actually fill out our template like we have over here. So we're going to put our accounting profit as our first field, and then we're going to have our non-temporary and temporary differences over here. Possibly we might have this as well, but usually it's just those two. And then the total is going to be our taxable income, and then we're going to times that by our tax rate. Well, I guess we need to adjust for any imputation, gross up and tax credits, just look out for those. And then we'll times that by a tax rate, and that'll get us our current tax liability. Okay, so the first thing that we're going to need is our accounting profit before tax. So let's have a look at the question and see if we can find that. So we can see over here straight away that they're saying that the draft profit before tax is $4 million. And then let's just read the rest of the question and see if there's any adjustments that we need to make. So it's saying down here that the following information has become available that had not been recognized. So we may actually need to make an adjustment for this. So Darcina was successful in a lawsuit relating to a competitor infringing patent 2 years earlier. Darcina received $800,000 in compensation from this competitor. And we've got this advice over here that compensation payments are actually assessable for tax purposes when received. So what we're going to have to do is we actually have to add back that $800,000 to the $4 million because it's not included in the $4 million that says up there, but we do need to include it for our purposes. So what we're going to do is we're going to start off with our accounting profit before tax of $4.8123 million. Okay, so now what we have to do is work out the adjustments between accounting profit and taxable income. And the reason we need to do that is because our tax is paid on taxable income, not on accounting profit. Now, as we learnt in the key content modules, is that there is different treatment for some items for tax and accounting purposes. So this is why we need to make these adjustments. Okay, so the first one, software license. We need to figure out if we need to make an adjustment to our profit to fit into one of these categories. So in this case, they've acquired software license for $240,000. The license is effective for 3 years. So we're saying $100,000. So for tax treatment, $100,000 of that purchase price is deductible for tax. The remaining $140,000 will be tax deductible equally in the years 31. Okay, so what we know is the trick here is it's saying that the following items have already been included in the $4 million using the appropriate accounting treatment. So we need to know how each of them are accounted for under the FIN IFRS and also for tax. Although we don't, because this isn't the tax module, they tell us how it's treated for tax. But we do need to know how it's treated for accounting. So what we know about licenses is that they're generally capitalized. So that means that they haven't expensed any of it. But what it does mean is that there is going to be a $100,000 deduction for tax. So we're actually going to reduce our taxable income because we're having an extra deduction for tax that we're not having for accounting. So we need to do a negative $100,000 in one of these adjustment fields. The reason we're going to put it in temporary is because temporary just relates to timing. I mean, eventually they're going to get a deduction for it when they, amortize it and get that deduction over time. We're just bringing forward that deduction earlier for tax purposes, so therefore it's a timing issue rather than a structural how you actually treat it. So this is going to go into temporary. So software, we go minus $100,000. Okay, so for the next question, we've got some consultancy service revenue over here. So we're saying for accounting purposes, the contract was from February to April 2017, and the fee was $120,000, which was paid up front. Now, of course, accounting is based on an accruals basis, so we need to recognize the portion. Well, if they did it correctly, they would have recognized the portion of the period that was actually incurred. Now, if we look above, the financial year of this client is for the year ended 31 March 2017. So they're not on a June year end. So if you think about it, in that year, they would have only recognized 2 months, so February and March, when in reality the total contract goes from February, March, and April. So even though they've received $120,000 in cash, they would have only recognized $80,000, or 2/3, for the 2 months out of the 3, up to the end of March. So in their P&L, what they've got is contract revenue of $80,000. So I'm just going to reverse this out, and after reversing it out, I'm going to add in the tax treatment. So you could just do this as one line and just show the difference, but I'm going to split them out separately. So contract revenue accounting, contract revenue tax. So now, how is it actually treated for tax? Well, we know that over here, the income is assessable for tax purposes when received by Darsena. Okay, so because they received it during the FI17 year, we're going to have to recognize the whole $120,000, and that's it. That's how you do that part. Okay, so for the next one, so 4, we know that the annual leave expense was $130,000, so that's what would have been in the P&L, and the annual leave paid was going to be $150,000. Okay, so that's what's in the P&L there. And for tax, we know that the annual leave is deductible for tax when it's paid. So this one's pretty straightforward. All we have to do is we have to reverse out the accounting expense and put in the tax accounting, or the tax expense, I should say. So how do we do that? Again, this is just the timing. So we'll go annual leave expense accounting. Now I'm going to go plus 130,000. The reason I'm going plus 130,000 is I'm taking out the accounting expense. So when you take out an expense, you're increasing the profit. Okay, and then what we're going to do is we're going to put in our tax component. So that's going to be 150,000. We go minus 150,000. Cool, super straightforward. We're smashing through this. Okay, part 5, share-based payment. Okay, so for question 5, it's actually drawing upon a different chapter in the FIN module, which is share-based payments. So that's what the CA tends to do, is that they'll, for the 1 or 2 markers, they can draw from multiple different topics. So even though the one question in this case is just based around tax, they do actually reference some of the other topics to just make sure that you have a holistic understanding of the core content. So in this case, we're going to have to actually go through the method of calculating what the share-based expense is for FIN, so that we know what the difference is between accounting and tax. So tax, we know that it's non-deductible, but for FIN, we need to know what the actual expense is so we can actually reverse it out. As this is a structural difference. So for this one, it's actually going to go into the non-temporary differences, because for tax, it's treated one way, and for FIN, it's treated another. So they're never going to be the same. They're never going to overlap, depending on timing. It's just not going to be the same. So the way that share-based payments are calculated is based on the fair value of the options actually vesting. And not only that, but we need to do it from the starting year, not just in the year that we're working off, which is FI17 with the March year end. We need to do it for all years. The reason is because once we've figured out what the fair value of the liability is, we just need to adjust it for the movement, and the expense will just be the movement between prior year and current year. So in this case, we only have to work out 2 years, fortunately. So FY16 and FY17. Okay, so I'm just going to put our calculations down the bottom, and we'll just make a reference up the top when we're actually doing it. So note here and note there. So for share-based payment, we can go note 1. This is how you should set it up in your exam. Just put your workings down below. Okay, so for share-based payment, year 1. So what we need to do is figure out, okay, so we know that there's 8 executives. So our calculation is going to be, so 8 executives. Actually, what I'm going to do is I'm going to bring up the journal template from this chapter as well, just so we can have them side by side. So we've actually got the journals that we need here. So number of staff expected. So we know that there's 8 staff, and we're not expecting any of them to leave. So we're going to go 8, which is the number of staff expected in year 1, times the number of shares, which is going to be 5,000 share options, times 5,000. And then we need to times it by the share price at the period end. So times that by $5.10, which is right there, 5.10. And then times it by the portion of the vesting period complete. So in this case, it's times 1/3. Okay, so that's what our fair value of the liability should be. And then of course we need to subtract it from the previous balance to get the expense. So in this case, the previous balance was 0. Therefore, the expense would be that minus that. So 68,000. That's in the previous year though. Okay, so what we need to do in year 2, which is actually FY17, which is the year that we're working off, to FY17, what we're going to do is we're going to go, let's follow the formula again. So number of staff expected. So by 31 March, none of the executives had left, but it was anticipated that 1 executive would leave. Okay, so we'd actually subtract for that 1 executive, so it's going to be 8 minus 1, so it's going to be 7. What's next? So it's number of shares, so it's still going to be 5,000, and then it's going to be times the share price at the end of the period, so it's still going to be $5.10, it hasn't changed. So times by 5.10, and then what we need to do is times it by 2/3, because it's the second out of the third period. We can see that they're vesting in 2018, so 2/3. Okay, so there's our fair value of the liability, but what we need to do is we need to actually subtract the 2 from each other, and there's our expense right there, $51,000. So that's what they'd actually be recording in their P&L for that particular year. So we can actually include that up here. So what we need to do is we need to add back the expense. So we're going to increase like that. Okay, so for part 6, equity account investment. So Darcy owns 40% of the ordinary shares of CAANZ. It's another company and has significant influence. CAANZ made a $200,000 profit. Okay, so basically there's a few ways of accounting for consolidation. In the core content, you would have learned that one of those methods is consolidation. So when you own over 50% of a company, generally as the indicator, you actually consolidate all of the things up. So all of the revenue, all of the COGS, all of the EBITDA, all of the fixed costs. So it's actually combined in your P&L. The alternative is if you have less than 50% and no significant influence, you actually have an equity accounted investment. So basically you just report one single line of your $200,000 profit. Either way, it doesn't really matter, because if you are consolidated or if you're just using equity accounting investment, either way, Darcina is going to be reporting. It will make a difference. The reason is because if you're consolidating, then you're going to be reporting 100% in all of your profit lines, and then you adjust out the portion, the non-controlling portion, below or through OCI. Whereas if you're reporting as an equity account investment, you're only going to be reporting the 40% of the $200,000. So it'll be, so it'll be $80,000 profit. So whether or not they are using an equity or consolidated method is going to make the difference between Darcina currently reporting $200,000 in profit or $80,000 in profit. Now, because they own 40%, and they've said here it's equity account investment, it means that they're only reporting the $80,000 in their P&L. So for tax purposes, we know that they've reported $80,000 in their net profit. Now, on the other hand, for tax purposes, it's saying that we only record the cash amount, which is the dividend, of $40,000. Okay, so basically what we have to do here is we have to add back the we need to remove the profit of $80,000. So we'll go equity accounted profit can be go $80,000. Well, sorry, we should probably be. We want to remove the profit, so we're going to go negative 80,000, and then we want to do dividend tax treatment can be. We want this to be equal to 40,000 times 0.4. So there's our correct profit. Okay, so we're almost there, but the last thing that I recommend that we do is just to go back and check everything. So I always recommend that when we're going through it, just to make sure that we haven't missed anything. And sometimes we've gone through each of the numbered items, but there's also elements in the question itself that we need to adjust for. So let's start from the beginning again and just make sure we've covered everything. Okay, so let's go back to, there's nothing in the text up here. So for the draft profit. So what about this compensation, the $800,000 in compensation from the competitor? Have we adjusted for this for tax? I know we've adjusted for it for accounting purposes, but have we adjusted it for tax? So they're assessable for tax purposes when received. However, they received this in April 2017. So even though we need to recognize it in accounting profit because it's been incurred, what we need to do is actually remove it out for tax as well, because this is something we missed on the first run through, is because of the timing difference. So it's going to be assessable in April, which is just going to be just outside of this financial year. So we actually need to adjust for this in the temporary differences as well. So let's just put in here lawsuit revenue tax. Let's go negative $800,000. Perfect. Okay, so that should fix that. What else have we got to do? Software license. So I mentioned before when we were going through the software license that there wouldn't have been any expenses in here other than because it's been capitalized. However, what we didn't take into account is, even though we mentioned it, is the amortization expense. So they would have acquired it on 1 December 2016. The license is in period for 3 years once operational. Okay, so the license is effective for 3 years once operational. The software became operational on 1 Jan 2017 as part of the implementation of a new computer system. Okay, so the trick is it's not when they purchased it, it's when it's become operational, which was from 1 Jan 2017. So how many months is that till 31 March 2017? So it's January, February, March, so it's 3 months. And the depreciation rate over 240,000 is over 36 months because it's 3 years. and then what we need to do is times that by 3, because that's the January, February, March. So there we go, $20,000. So there'd actually be $20,000 of software license expense in the P&L that we actually need to reverse out. Software amortization, 20,000. Cool. Let's just do a quick review. So I think we covered everything for consultancy fees. That one's fine. That one was quite straightforward for annual leave. Share-based payment we did correctly. There was nothing for tax. And then equity accounting we did correctly. There was nothing there. Okay, so just by going through that review process, we did pick up 2 issues. So it is an important part when you're doing your exam. Don't just rush through it and forget about it, move on to the next question. Actually spend some time going through it so that you actually don't lose any silly marks from a couple of silly mistakes. Okay, so what else do we need to do? So we've got our accounting profit. We've got our adjustments. What about our taxable income? So we need to go... Okay, so to work out our taxable income, we need to go that plus our non-temporary plus our temporary deductions. That's a taxable income. And our current tax liability is therefore that times the tax rate, which is 30%. So 1178. Now, do we need to look for any adjustments, movements in prior year in the provision for current tax? No, we don't, because it just says calculate the current tax liability. So that's it. That's 20 marks right there. We got 20 out of 20 for that question.